Traders all around the world, this is FXPassion broadcasting you live on YouTube and this is Forex Trading Course 101. And remember, we are at the professional level. For the beginner traders, we are talking about and we are learning about hedging. And remember the three pillars. In order to be profitable, we need to have and understand an edge. We need to have a strategy and or a system. We need to understand how risk management works, and we need to understand and work upon a big one, which is the psychology part. Remember, 90% of traders lose money in the Forex market worldwide, and the webinars are not investment or trading advice, everybody. The webinars are for educational purposes only. Either way, don't trade with money you cannot afford to lose. Hello Miguel, ¿cómo estás? ¿Todo bien? ¿Cómo está España? Everybody, if this is your first time and you don't quite understand about hedging and what we are doing, please go back to the Stohastic YouTube webinar page and the channel and try to find Forex Trading Course 101 and try to start to watch the course starting from lesson 1. Okay, that being said, let's dive into the live markets and let's talk again. We started talking about hedging and we jot down a few numbers. So number one, a hedge is for protection and not for profit. Number two, hedging is not suitable for all traders. Why is that? Because hedging is considered and classified as a high risk strategy. And what is the reality? The reality is hedging is a very safe but also very misunderstood. Number three, a hedge is a trade. It must have a stop loss and a take profit. Number four, if not done properly, it is going to blow your account. So we talked about this one. This was the example where we hedged, in theory, we hedged a trade. And the market was going against us, the market was going against our original trade, but because we were making money with our hedge, we increased our floating loss. And this is a sure way to lose an account. Time to shine. Hello sir. Hello, time to shine sir, how are you? So we have this now. We have these rules, right? Number five, the hedge is going to increase your risk reward, and we talked about the risk reward. This was 2 weeks ago, everybody. Last week I couldn't make it, so we made an example on Euro JPY where we were not fortunate enough to have a loss, so our hedge was not triggered. And also here we wrote some rules. Rule number one, you cannot put the hedge everywhere and anywhere. You need to have a technical reason that can explain the hedge. And when you are wrong with the original trade or with the hedge, you must close the trade with the loss. So we need to accept the loss. And the big one, it's psychological. More than anything, you don't want the hedge to be triggered. So the hedge is for protection, not for profit. And here our hedge was not triggered. I don't remember the trader who said, oh, let's make an example on Euro JPY, but we are in profit, right? We were trading in the right direction, so our hedge was not triggered. So this is okay. And then we were talking about the problem, right, and the solution, and how the beginner trader is going to lose money using this simple hedging strategy. Remember, there are different models, different ways, different hedging strategies. This is just for the beginner trader, everybody. Annie, hello, how are you? Stoyan, hello. And as a rule, everybody, we said we can hedge maximum one time per currency pair. Rule: if operating with the hedge, we are going to talk about the business operation. And then we said, what is the solution? So in the last lesson we talked about, and we ended understanding that even though we change the risk reward, this is not going to help. So if the market is going to trigger our hedge and finally is going in our direction, then we are going to have a loss, and this loss of the hedge is going to increase our risk, or in other words, is going to diminish our risk reward ratio and our profit target. Everybody, let me just cancel the Skype. Where is the Skype? Let me see. Okay, hopefully end of conversation. Close the Skype. End of conversation. Okay, there you go. Okay, and we said, well, if the hedge is triggered, right, what is the solution? Either way, right, what is the solution? Because the market can do anything it wants and everything it wants. So what is the solution? The market goes down, goes up, right? And we said the solution is we must add a position, and we must make back what we have lost with the hedge. Okay, so this is the solution. Now let's continue. There are some other rules. Okay, text. So rule: the second trade which goes in the same direction as the original trade is going to have a stop loss. Pure and simple, everybody. Okay, so this is the solution. Okay, let's write this down. Okay, let me see. Okay, there you go. Daily chart. Okay, so this is the rule. We need to add a position, and because we must make back what we have lost with the hedge. And another rule: the second trade, which goes in the same direction as the original trade, is going to have a stop loss. Okay, what does this mean? This means, let's try to find okay, there you go. This means what? So we have the A to B, we have our Fibonacci, hopefully. This is the A to the B. And of course the market was retracing, is just an example. And then finally the market made a crown. Looks like it reversed, right? So we entered buying here, the counter trendline break. Green is our entry, and our hedge, instead of the stop loss, we are going to have our hedge down here, right? So this is the hedge, and up in here, I'm going to clone this. Up in here we are going to have the stop loss of the hedge. Remember, a hedge is a trade. It's not supposed to make you profit, it's just for protection, right? And we said when the market, sometimes we entered, the market went up, we entered after the counter trendline break, which is here. Let's make it blue like this. Okay, and then the market reversed and pushed back, right? This is sometimes in a period of consolidation, and then finally moved back again and hit our stop loss of the hedge, right? And we said, well, what is the solution to have the same risk reward as the original trade? We said, well, we need to add another position, right? So we would enter we would enter on the next counter trend line break. Okay, now there are also some rules about this one. Okay, so let's write this down. This is what I'm doing personally. Okay, and remember, this is hedging for the beginner traders, everybody. There are different models out there, complex formulas, but this kind of hedging is quite easy for the beginner trader to understand. So, rules for the second trade. Number one, enter only with confirmation from the, this is going to be number 2 actually, this is going to be number 2. So number 1, we are allowed to enter just one hedge. Okay, this is number 1 per currency pair. And number 2, enter only with the confirmation from the higher time frame. Okay, passion is not clear. Okay, let's go step by step. Thank you for the comment. Step by step, let me write down A, B, Fibonacci, right? A, B, then we have the C is down here. Okay, so it's not clear. Well, let's go back on the previous. So our original trade, everybody, our original trade, we would, I'm going to delete most of the things. Okay, delete, profit target, solution, delete, so it's not going to confuse you. Everybody, if this is your first time with us, and this is the third lesson about hedging, so please go back on the Stohastic YouTube channel, okay, and watch the lesson number 1 on hedging. Okay, so ABCD, right? For the trader on the other streaming platform, everybody, he's saying it's not clear. Well, as a beginner trader, I wanted to buy whatever, you know, Euro JPY, USD JPY, whatever. Okay, on any time frame, doesn't matter, daily, monthly, weekly, 1 hour, 2 hour. Okay, but initially as a beginner trader, I learned about the Fibonacci's, and I would put a stop loss down here. Okay, so this is our original trade. This is our risk, and green goes to green. This is our reward, right? But instead of the stop loss, I'm going to put a hedge below my C. Because why is that? Because this is the lowest point inside the AB boundary. And again, on the other platform, somebody is asking, not on YouTube, but on the other platform that I'm also streaming, somebody is asking, Passion, is any difference if we have a confirmed C or not confirmed C? The answer is no. The answer is no. Miguel is asking, how can you delete so quick? Practice, Miguel. It's just practice, you know. Okay, so this is our plan, and this is our original trade. Now, instead of just me having a stop loss, I'm going to use the hedge. I'm going to put a sell stop order down here. Sell stop order. Okay, sell stop order, which equals the hedge. So this is my hedge. Okay, so this is my hedge, it's a sell stop order. Why? Because the hedge is not for making me a profit, but it's for protection. Because if the market goes down, right, and stops me out with my original trade, then the hedge, the sell stop order, which when triggered becomes a sell order, is going to give me some profit. Remember that this technique it's not for you to make profit, it's just for protection. Okay? Either way, if it's not going to stop you out and if it's going to go wishy-washy up and down like this, then it's going to increase our risk, and it's going to mess with our risk-reward ratio. Okay? Now, if this happens, now we said we have different scenarios. Number one, the market is going to hit the hedge and stop us out. This is okay. We are going to have a lower loss because the hedge is going to give us some pips, right? Now, as happened on Euro JPY, the other scenario is we are going to enter the market. It was a sell trade in this example, and the market went in our direction, so our hedge was never triggered. This is the second scenario, which is okay. The third scenario, where beginner traders are going to blow their accounts, okay, are going to burn their accounts, is when the market is going to hit the hedge. Okay, so we are going to have a sell order in place, and then it's going to reverse. And we said, because a hedge is a trade, the hedge must have a stop loss, and this stop loss usually is above the crown in this example, right? And also the hedge must have a take profit, which is 10 pips, 15 pips in front of the A. So this is the hedge. Hedge is an order, it must have a stop loss and a take profit. Time to Shine is asking, and we close the hedge once hits our original stop loss. The market is going to close your hedge, Time to Shine, before, because you are going to have a take profit 15 pips, 20 pips, whatever, in front of the A. Okay? Everybody listen to me very carefully. Don't play with hedging. Don't play around with this. It's very dangerous. This is why hedging is considered a high risk technique. Don't play around like, oh, I'm going to leave my take profit opened. Don't do this. Don't play around. This is dangerous. It's going to increase your risk, and it's going to mess with your risk reward, everybody. Okay? So when you enter the hedge, have a stop loss and take profit in place. And then, depending what is going to happen, you need to manage your business, right? If operating with the hedge, we are going to talk about a business operation, right? So we have a business to manage. It's the original trade, it's the hedge. And let's say that the market hit our hedge, but it didn't hit, never hit our take profit, but it hit our stop loss of our hedge. So we have a small loss, right? And now we are here. So the market hit our stop loss of the hedge, and we have a small loss, right? Then we're going to talk about calculations, everybody. Don't panic, okay? I'm going to show you something. So, and we said, well, how can we get our risk reward in place and the money and everything? And we said, well, we need to add another position because we need to earn back what we have lost. We need to earn back this one. Time to Shine is asking, so there is a scenario where our hedge reaches take profit, then reverses, and our original trade goes. Yes, sir, this is the point. This is the good stuff, Time to Shine. This is the good stuff. This is the good stuff. But this is what happens that What happens the majority of time, everybody, is this one. Why is that? Because beginner traders, most of them, they don't listen. Right? We are telling you, you cannot put a hedge everywhere and anywhere, everybody. If you are going to put a hedge in the wrong place, then the market is going to take you in the opposite direction, and then it's going to reverse. And you are going to have a headache. Believe me. And then you are going to re-enter 2 or 3 times against the market, and you are going to burn your account. Right? So don't play around with this. Backtest first, play with it on the demo account, and only later you can use it on the real account. It's very dangerous, everybody. Okay? You can make so many mistakes in here. Why is that? Because the market is moving. You know? I'm going to tell you where the beginner trader loses money, even learning the hedging technique. The beginner trader loses money in here, in this market behavior. This is where most likely the majority of the beginner traders lose money with hedging. This one. Because they are confused, you know, they have 2 orders, one in the right direction, the other is going against them, and the market is making higher highs and lower lows. And then we start to panic as beginner traders, and we lose focus, and we don't know where the head is and where is the tail. Okay? So it's dangerous. If done properly, it's going to lower your losses, it's going to protect you, but you need to follow the rules, everybody. Okay? Now back to the original trade and rules for the trade number 2. We are allowed, edit label, we are allowed to enter just 1 hedge per currency pair. Number 2, enter only with the confirmation from the higher time frame. So this entry, if I am trading, if I executed my trade, so original trade was on the 4 hour / 2 hour / 1 hour. Okay, I need to. So our original trade was on 4 hours / 2 hour, 1 hour. The second trade, and we're talking about the entry, must be from higher time frame, which is the daily. Okay, so our original trade, let's use a circle. Our original trade was here. First circle, this is trade number 1. So first trade number 1 is the first circle, and our second trade, edit label, is here. This is our second trade. But this is where beginner traders don't listen, and I'm posting time to time on LinkedIn, Passion, can you help me? And I said, I can't. Why not? Answer, because you don't listen. The second trade must be from the higher time frame. So here on the 2 hour chart, 4 hour chart, 1 hour chart, whatever, I saw a crown, I saw a counter trend line, I saw the past support and resistance, you know. The second trade must be from the higher time frame. So I cannot enter from the 1 hour chart, 2 hour chart and 1 hour chart. Okay? Oh, but I have a crown. It doesn't matter. You need to have a crown on the daily. Oh, but I have a counter trend line break with the bullish candlestick formation. It doesn't matter. It must be from the daily chart. Everybody? Okay? So this is a must. So what we are going to do, we are going to go on the daily chart, and it's just an example. If all of this, let's let's make it like this. If all of this is going to be a beautiful bullish engulfing candle, just an example, bullish engulfing candle, then we are going to enter at the close of the bullish engulfing candle. It's just an example, okay? Now, where is the problem? The problem is not the right word. What is challenging? The challenge, everybody, is that we as beginner traders, we are used to enter on the 1 hour chart, 2 hour chart, 4 hour chart, and on the smaller time frames there is always action, right? But now, because we are hedging and we lost on the hedge, we need to wait 24 hours. Because it's the daily chart, we need to wait for the daily candle to close. And this is challenging. And this is where, I'm talking you from my experience, this is where the students don't follow the rules. Students enter on the 1 hour chart, 2 hour chart, oh, it's a crown, it's this and that, right? You need to wait for the confirmation. It could be whatever, everybody. It could be a counter trendline break on the daily, in this example. Could be a bullish candlestick formation on the daily. Could be both, you know, but it must be from the daily. And when we enter on the second trade, we are going to put, if the reason to enter is the bullish candlestick formation, we are going to put a stop loss on the second trade 15-20 pips above the bullish candlestick formation. This is for the second trade, everybody. And we are done. Okay? And we are done because of this. If the market, now there is a logic behind of this. Why the second trade must be from the higher time frame? The reason is because the higher time frame controls the smaller time frame. So if a bullish candlestick formation appears, this is not guaranteed, but it's going to increase our probability for our original trade and our second trade to be a success, right? Okay, now number 2, the second trade is going to have the same risk as the hedge. Why is that? Because we need to earn back what we have lost with the hedge. Now, where another rule where beginner traders don't listen, everybody. So rule, with the second trade we must earn back what we have lost with the hedge and not more. Not more. This is rule number 3. Well, let's make it here number 3. This is the third rule. Okay. Time to shine. If the daily candle has closed, would the entry only be at the start of the new candle? Because sometimes we might see the candle halfway through the day. Yes, the answer is yes. You need to wait for the close of the candle. Only at the start of the new candle. The answer is yes. No exceptions. Yes, sir. Number 3, where beginner traders don't listen. With the second trade, we must earn back what we have lost with the hedge and not more, everybody. So if we have lost 0.5% with the hedge, we should make 0.5% with the second trade. $1 million and trillion euro question. Why is number 3? Why we shouldn't earn more? Who knows, everybody? What is the answer? And this is where beginner traders lose money, burn the accounts. It's all emotional. I lost with my hedge, now I'm going to get back, you know. So we enter in an emotional state called revenge. And we see a beautiful bullish engulfing candle, and we are in an emotional state of revenge, and we say, well, if I lost 0.5%, I'm going to make back 2% with this second trade, because FXPassion said it's a good strategy and blah blah blah, you know, because then we are risking too much of account. Yes sir, time to shine. Would you be more, can you explain more? Everybody, why is number 3 so critical? Why should we earn back the exact amount that we have lost with the hedge and not more? Why is that? Time to shine, you are correct, but can you explain a little bit more? Because then we are risking too much of our account. For some beginner traders it's not clear. Can you explain further? Everybody, every trade has a risk attached, right? So I'm going to explain. In the meantime, I have a 20 seconds delay on the chat. What Time to Shine is trying to say, and congratulations to you, Time to Shine, is that if we have lost 0.5%, 0.5, because hedging is not for profit. Yes, Miguel, but we are not talking about hedging anymore. We are talking about making back what we have lost. Let's say that I have lost 0.5% with my hedge trade, and I'm going to, because I want revenge on the market, I'm going to enter risking 2% on my second trade. 2% on my second trade. What's the problem here? I have my Stohastic is in the right place, my Fibonacci are telling me that the market is going to go up, my super mega trading system robot JP Morgan Chase crystal ball is saying that the market is going to go up. So I said, well, what the heck, right? I'm going to earn back not just 0.5% but 2%. Time to shine, you are not following rules, right? So I'm risking whatever, right? But let's say that I'm risking my first trade, I was risking 1%. I was risking 1% with my first trade. I was hedging 0.5%, which is okay. Hedging is for protection, not for making profit. But then because I'm emotional and I want revenge, then I want to make back, and I'm going to make back 2%, right? What is my overall risk, everybody? Everything is in place, but if for some reason, it doesn't need to be a news event, but if for some reason the market does this, how much did I lose? If for some reason the market does this, how much am I going to lose? And the second question is, how much should I have lost? How much am I going to lose because I want revenge on the market? And how much should I have lost if the market takes out the A? Red color like this, and like this, transparency, there you go. And this is our stop loss down here. Stop loss of the original trade is down here. 3%, right, Miguel? I lost 3%. How much should I have lost, everybody? If the second trade doesn't work out, how much should I have lost? Time to Shine is saying if you lose 1% on the first trade, 2% second trade, but again 0 point from the hedge. Correct? Question for you, everybody. How much should I have lost if I would trade according to the rules? According to rule number 3, with the second trade we must earn back what we have lost with the hedge and not more. 2%, right? Yes, Time to Shine. And this is the difference, everybody. You are changing your risk-reward parameters, right? I'm talking to some beginner traders. They want to start their career in hedge funds, proprietary trading firms, right? And they are not accepted. Why? Because they are doing this kind of mistakes, everybody. Miguel, 1.5. Yes, Miguel, you are also correct, but Time to Shine also calculated the loss from the hedge. But you are correct, 1% plus half percent is 1.5. Everybody, if you are thinking to become a professional trader, okay, from all of my heart, I hope you get where you want, but you must not do this kind of mistakes. Okay? Of course, I've done this, I'm telling you, and it's normal, okay? But with time, when you are trying to figure out the Forex market the first year, and the second year, and the third year, you know, you must not make this kind of mistakes anymore. And this is an emotional mistake, everybody. Okay? This is why we are telling you the big one is the psychology part. You can learn hedging, it's not that difficult. You can give classes about hedging, it's not that difficult. But when we trade, you must not get emotional, everybody. Okay? I've seen countless traders burn their accounts, losing money, losing other people's money because of this. They get emotional, they want to prove themselves. They promise to the neighbor 15% until the end of the year, and they are after the market. They want revenge, you know? And when this happens and we get emotional, and this is at the professional level for the beginner trader, then what happens? Oh, it's FXPassion fault, the broker is against me, Ducascopy doesn't work, the platform is rigged, the Forex market is rigged, God doesn't love me, you know, it's my spouse's fault, it's my husband's fault, it's my cat's fault, you know. I lost because I didn't sleep well because my dogs were barking last night. It's everybody's fault, which in reality is not. It's ours, right? So we need to pay big attention not to get emotional, especially if we are going to use hedging. This is why hedging is considered not suitable for most traders, and it's considered high risk. Time to Shine wrote a message and oops, not supposed to enter. Okay, everybody. Number 3, when the second trade we must earn back what we have lost with the hedge and not more. Number 4. And it's a rule, we are done for this business. We are done. Okay, this is for beginner traders. We tried everything, right? We analyzed the market in the multiple time frames. We have the confirmation from our confirmation time frame and the trading time frame. We have structure, the Fibonacci's, the market wave. We enter the trade, we put a hedge. The market took us in, took us out. We have a small loss and we entered the second trade from the higher time frame with the stop loss and the take profit, and we are done. No more trading for this currency pair, everybody. Okay? Now, two things are going to happen. Thing number one, 80% of the time, if you are going to follow the rules, 80% of the time the market is going to go our way and we are going to hit our take profit and we are going to earn back what we have lost and everything is going to be okay. This is 80% of the time. 20% of the time is going to happen the yellow. The market is going to, it doesn't matter for what reason, it doesn't need to be a news event, everybody. Central bank changing rates, it doesn't need to be this, but for some reason the market is going to go down and is going to stop us out. It doesn't, we are done, everybody. We are going to lose 2% in total, and this is also okay. This is a beginner trader becoming slowly, right, becoming a professional trader. The process, following the rules. We are going to make money, it's okay. We are going to lose, still okay. Because did we do anything wrong? No, right? We follow the rules, everybody. Now, listen to me very carefully what I'm going to say to you. If you are working for me in my hedge fund, and if you are making money, if you made money breaking the rules, you are fired, everybody. You are fired. Oh, but I just made you whatever, you know. I just made you 1 million. You are fired. I've seen this, everybody, when I was trading in an investment bank. A trader made, I don't remember, it was 2 million euros or whatever. A trader made 2 million euros, it was fired. And then he came, yes you can, time to shine, just prove me that you are profitable. And then he come back with their parents. This is not fair, we are going to call the police, you know, and this is fraud and whatever. And the manager, in that time the manager put everybody in the conference room and he asked the trader who's been fired, how much did you make? I don't remember the exact number, but let's say he said, oh, I made you 4 million euros, you know. And then the manager said, how much did you risk? And he said, right, he said nothing. And the manager said, during this trade that you made money, how much was your floating loss, which you can find on the chart? And the trader said 24 million euros. Everybody. So if you make money and you break the rules, you are getting fired. If you lose 2, 3, whatever, 5 times and you follow the process, you can keep your job, everybody. Can you understand this? Tell me you understand this, everybody. And of course, yes, there are different firms, different companies, institutions, you know, they are not so rigid, right? But most of them that I know, I have some friends around the world and we talk, you know, most of them are very aware of this. They said your maximum risk exposure is 10% and you expose yourself 11, you are fired. You know? the same day. Pack your stuff, go home. Oh, I'm sorry, there is no sorry. You disobeyed the rules, you know. Time to shine, agreed, and he says yes. Okay. One last thing, everybody, before we end this lesson today. Where is this? You can, before you trade, before you hedge, you should have, you can do this on Excel. There is no rule, right? You can do this on Excel and there is no rule, but you should build your money management system. And what I want to show you, so let's go step by step. We have here chart time frame. Okay, you have the capital, you have the risk per trade, which you insert manually, 1%. Risk per trade is how much money, currency pair. You can adjust this as you want, no problem. Entry price is going to be manual. Stop loss price of the original trade, manual. Hedge entry price, manual. You need to choose where is going to be your. So I have here stop loss is the A of the Fibonacci, and the hedge entry price is going to be the C of the Fibonacci. But you can do it as you want, no problem. There are no rules, right? Risk in pips until hedge is going to be triggered. It's automatic. Volume sell until hedge triggered. So this is the volume of the hedge. Hedge stop loss is going to be manual. You need to put it down. And you have the take profit, it's automatic. Risk in pips, it's automatic. Stop loss, it's automatic, everybody, because it's calculated based on the percentage. And the important thing is here. Let's make it green. No, not. Let's make it what? Purple. That's it. There you go. Hedge volume, it's manual. Okay? It depends on what take profit and stop loss in comparison to the original trade. So if I'm going to change my from 0.4 to 0.5, then it's going to change my hedge profit and the take profit of the original trade. But the important thing, before you enter the hedge, you must have at least this one. You must have a calculation for if the trade goes my way. Number one, you must have a calculation if the trade didn't work. As you can see, Passion, can you send me your table? Can you send me your Excel sheet? I can't, but you are not going to understand anything, everybody. I can send you this, but I send to some other traders. It's not useful, you know, because this is how your head thinks. I can send it to you. Just send me an email, okay? So you must have trade going my way, you must have trade didn't work, because you need to see what is the result, right? What is going to be the total result in pips and money and percentage, right? As we said, you cannot play around with this. You should have lost 2%, but because we were in a revenge state, we want revenge, we lost 3%. And some traders lost 5% or 7 or 8 and try to hedge 2 or 3 times, and you are out of the game, everybody. You just burned your account. So this is one of the webinars, everybody. To watch them, try to watch them 3 times. Okay, and trade hit but the hedge. This is the last one, calculation. Trade hit the hedge but then reversed and work out. So I'm going to have stop loss. I mean, here the hedge stop loss in pips, right? So number one, trade going my way, the hedge is not going to be triggered. Number two, so this is number one. Number two, the trade didn't work, so I have a loss. Number three, the trade hit the hedge but then reversed and worked out. This is where I'm going to have a loss, a small loss because of the hedge. The market hit the stop loss of the hedge, but then in the end the market worked out and I earned what I supposed to earn. Okay everybody, happy Friday. This is it for today. See you back next Friday, right? Have a great weekend everybody. Try to watch this webinar over and over and over again. And remember, stay strong and trade with passion. And don't make mistakes everybody. This is FXPassion signing off. Bye bye. See you next week everybody. Have a great weekend.